You probably think your biggest problem in trading is finding the right strategy. It isn't. Your biggest problem may be what happens to you after you enter the trade. Because before you enter, everything feels easy. You look at the chart, you see your level, you see the direction, you imagine the trade working, you calculate how much you could make, and for a moment, you feel completely in control. Then you enter, and suddenly, the same chart looks different. The candle moves against you. Your heart starts beating a little faster. You start watching every small movement. You begin questioning the trade. You tell yourself the market is probably going to turn. Then price moves a little further against you. Now, you are no longer following your plan. You are negotiating with the market. You move your stop loss. You tell yourself you are giving the trade more room. Then price moves even further. You add to the position because you believe the market has to come back. Now, the small loss you originally accepted has become something much larger. And when the trade finally closes, you don't just lose money, you lose confidence. You become angry. You want the next trade immediately. Not because there is a good setup, but because you want your money back. And that is where the real damage begins. Most traders think risk management means deciding how much money to risk before entering a trade. That is part of it. But it is not the whole idea. Real risk management is also about controlling what you are capable of doing when your emotions become louder than your reasoning. And this is the part most traders miss. Your greatest risk is not always the amount you put into one trade. Sometimes your greatest risk is what you are willing to do after that trade goes wrong. Think about that for a moment. A trader can have a perfect strategy and still destroy an account. A trader can risk only 1% per trade and still become reckless. Because risk is not just about the first decision. Risk is also about what happens next. Imagine you risk 1% on a trade. You lose 1%. Nothing dramatic. Your account is still alive. Your strategy is still alive. Your opportunity to trade tomorrow is still there. But then you become frustrated. You take another trade without a proper setup. You lose another 1%. Now you are down 2%. You feel pressure. You increase your position size. You want to recover. You lose again. Now you are down 4 or 5%. The original loss was never the real problem. The real problem was the emotional reaction to the loss. This is why my approach to risk management begins with something very simple. I have to make losing boring, not exciting, not terrifying, not personal, boring. Because if every loss feels like an emergency, you will eventually make emergency decisions. And trading is one of the worst places to make emotional emergency decisions. The market does not care that you need your money back. It does not care that you have bills to pay. It does not care that you lost 3 trades yesterday. It does not care that you have been studying for 2 years. It does not care that you are desperate for a winning trade. Price will continue moving, and your job is not to force the market to respect your expectations. Your job is to protect yourself while participating in something you cannot control. That is the foundation. You cannot control the market. You can control your exposure to it. That difference changes everything. A lot of traders enter a trade and immediately start thinking about profit. If this reaches there, I will make this much. If price moves here, I can double the account. If this trade works, I can recover last week's losses. And I understand why. Trading attracts the human mind with possibility. You see the chart moving, you imagine what could happen, but the professional mindset starts somewhere else. Before asking, how much can I make? Ask, how much am I willing to lose if I am wrong? That question sounds simple, but it changes the entire trade. Because when you know exactly what you are willing to lose, you stop treating the trade like a lottery ticket. You start treating it like a calculated decision. Imagine you are about to enter a trade. You believe price is likely to move higher. You have identified an area where you want to buy. You know where your idea becomes invalid. And you know how much of your account you are willing to put at risk. Let's say your account is $5,000. You decide that one trade should never cost you more than $50. That is 1%. Now, something important has happened. You have separated the trade from your emotions. You are no longer saying, I cannot lose this trade. You are saying, if this idea is wrong, I will lose $50, and I have already accepted that possibility. That is a completely different mental position, because the moment you truly accept the loss before entering, the market has less power over you. You don't need to move the stop. You don't need to pray. You don't need to stare at the chart every second. You don't need to invent reasons why price must reverse. You already decided what you were willing to pay to find out whether your idea was correct. That is risk management. You are paying for information. You are paying for an opportunity. You are not buying certainty. There is no certainty in trading. And the faster you accept that, the calmer you become. One of the biggest mistakes traders make is risking an amount that they cannot emotionally accept losing. They may say they are risking 2%, but psychologically, it feels like 20% because that money means something too important to them. Maybe it is their rent. Maybe it is money they borrowed. Maybe it is the money they promised themselves they would use for something important. Maybe they are trying to turn a small account into something much larger because they believe trading is their escape. So when the trade moves against them, the loss does not feel like a normal business expense. It feels like a personal disaster. And when a loss feels like a disaster, rational thinking becomes difficult. This is why your risk has to be small enough that you can remain emotionally functional after losing it. That is a powerful test. Don't ask only, can my account survive this risk? Ask, can my mind survive this risk without changing my behavior? Because your account may survive a large loss, but your psychology may not. And once your psychology breaks down, your future decisions become dangerous. This is why I would rather take 10 small losses than one loss that changes the way I behave. Think about a professional boxer. A good boxer does not walk into the ring believing he will never get hit. He knows he will get hit. The goal is to remain composed when it happens. Trading is similar. You are going to be wrong. You are going to take losses. You are going to have trades that looked perfect and failed. You are going to watch a setup work without you. You are going to exit and then watch price continue in the direction you expected. All of that is part of the game. The question is whether those experiences change your behavior, because losing a trade is normal. Losing control is not. There is another part of risk management that traders often overlook. It is not enough to decide how much you will risk on one trade. You also need to know how much you are willing to lose in a day. This is where many accounts are damaged. A trader loses one trade, then another, and instead of saying, today's not going well, I am done, they say, I just need one good trade. That sentence has destroyed many accounts because the trader is no longer looking for an opportunity. They are looking for emotional relief. They want the market to make them feel better, but the market is not a therapist. It cannot repair your confidence. It cannot erase your frustration. And it certainly cannot guarantee that your next trade will work. So I prefer to have a daily loss limit. For example, if my maximum planned risk per trade is 1%, I might decide that losing 2% in a day means I am finished for that day. Not because the third trade cannot win. It might, but because I recognize something more important. After 2 consecutive losses, I may no longer be the same trader who took the first trade. My emotions may have changed. My urgency may have changed. My patience may have disappeared. And that changes the quality of my decisions. This is something traders rarely measure. They measure money. They measure win rate. They measure profit. But they don't measure emotional deterioration. Yet, emotional deterioration can be more dangerous than a losing trade. Imagine losing 2 trades. You sit there staring at the chart. You see another setup forming. Normally, you would wait. Today, you feel pressure. You think, I need this one. That sentence should be a warning. The moment you need a trade to work, you have already given the trade too much power. You are no longer observing. You are hoping, and hope is dangerous when it is mixed with financial exposure. This is why one of the strongest forms of risk management is knowing when to walk away. Sometimes the best trade you can take is no trade. That sounds boring. And that is exactly why Many traders struggle with it. They believe trading means being active. Charts are open, candles are moving, news is coming out, markets are available 24 hours a day. There is always something happening somewhere. But just because something is happening does not mean you need to participate. A fisherman does not throw his net into the water every second just because the ocean is moving. He waits. He watches. He understands that movement does not automatically mean opportunity. The same is true in trading. A candle moving quickly is not a signal. A large candle is not automatically an opportunity. A breakout is not automatically a trade. A market reaching a high or low does not mean you should immediately enter. You need a reason. And more importantly, you need a reason that existed before your emotions got involved. This is where having a simple trading plan becomes powerful. Not a plan with 50 rules. A simple plan. What market am I trading? What time am I willing to trade? What kind of setup am I looking for? Where would my idea be considered wrong? How much am I risking? What conditions would make me stay out? And what will I do after a loss? That last question is incredibly important. What will you do after a loss? Most traders prepare for the trade. Very few prepare for the emotional consequences of the trade. They know where they want to enter. They know where they want to take profit, but they don't know what they will do if they lose. So the market decides for them. And that is dangerous. You need to decide before the emotion arrives, because decisions made before the storm are usually better than decisions made in the middle of it. Let's say you take a trade and lose. Your plan might say, I do not immediately enter another trade. You get away from the screen, you breathe, you review the trade later. Was the setup valid? Did you follow your rules? Was the loss simply part of the probability, or did you make a mistake? Those are two completely different things. A valid losing trade is not the same as a bad trade. This distinction can completely change your psychology. Suppose you followed your rules. You waited, you entered at your planned area, you placed your stop where the trade idea was no longer valid, you risked your normal amount, price hit your stop, you lost. That is not failure. That is an acceptable business outcome. But suppose you entered because you were afraid of missing the move. You ignored your setup. You entered too late. You increased your position size. You moved your stop. Then you lost. That is different. The loss itself is not the only thing to study. The decision-making process is, this is why I believe traders should judge themselves by execution before judging themselves by profit. You can make money from a terrible decision, and you can lose money from an excellent decision. It sounds strange at first, but think about it. You can gamble on a coin flip and get lucky. That does not make the decision intelligent. And you can make a careful decision based on good information and still get an unfavorable outcome. That does not make the decision foolish. Trading becomes much healthier when you separate process from outcome. You stop asking, did I win? And you start asking, did I do what I said I would do? That question is much more useful because the outcome of one trade is largely outside your control. Your behavior is not. This brings me to one of the most important parts of my risk management approach. I don't increase risk because I am losing, and I don't increase risk simply because I am winning. That sounds obvious, but emotions make this incredibly difficult. After a losing streak, you want to increase size because you want to recover. After a winning streak, you want to increase size because you feel confident. Both can be dangerous. The losing trader says, I need to make it back. The winning trader says, I'm on fire. Both are emotionally influenced. The solution is consistency. If your normal risk is 1%, your risk should not suddenly become 3% because you are angry. And it should not suddenly become 5% because you are confident. Your position size should be determined by your plan, not your mood. This is one of the quiet differences between gambling and professional risk taking. The gambler changes his bet based on emotion. The disciplined trader follows a predefined risk structure. And there is something else I want you to understand. Your stop loss is not an enemy. A stop loss is simply the point where you admit, my original idea is no longer valid. That's it. It does not mean you are stupid. It does not mean the market beat you. It does not mean you are a bad trader. It means uncertainty went against your idea. Sometimes price will hit your stop and reverse immediately. You will watch it happen, and your mind will scream, "See? I knew it." But be careful. You did not know. You hoped. There is a difference. If your stop was placed logically and your risk was controlled, the fact that price later reversed does not automatically mean the stop was wrong. Sometimes the market will move against you before moving in the direction you expected. Sometimes it will never move in your direction. You cannot know which one will happen with certainty. That is why your risk has to be small enough to allow uncertainty to exist. You don't need to be right about every movement. You need to survive the movements you get wrong. That is the real game. Think about a long journey. You don't need every road to be perfect. You don't need every traffic light to be green. You don't need to predict every turn. You just need to keep the vehicle under control. Trading is similar. Your account is the vehicle. Risk management is the steering wheel, the brakes, and the seatbelt. Your strategy is the map, but even the best map cannot guarantee that the road will be clear. You need to be prepared for uncertainty, and this is where patience becomes a form of risk management. People often think patience is simply waiting. It is more than that. Patience means refusing to risk money when your conditions are not present. That means you may sit in front of a chart for 2 hours and do absolutely nothing, and that is not wasted time. If there was no valid opportunity, doing nothing was the correct decision. This is difficult because your brain wants activity. It wants stimulation. It wants confirmation. It wants something to happen. That is why boredom is dangerous for traders. A bored trader starts creating opportunities. He sees a small movement and turns it into a setup. He sees price approaching a level and enters early. He sees another trader making money and starts feeling behind. Then FOMO appears, fear of missing out. You think, what if this is the move? What if I don't enter now? What if everyone else is making money while I'm sitting here? So you enter, and now you are exposed to risk for a reason that had nothing to do with your strategy. You entered because of fear. This is why sometimes the most important risk management rule is simply, if I don't understand why I am entering, I don't enter. You don't need to catch every move. There will always be another opportunity. Maybe not today, maybe not tomorrow, but the market is not running away permanently. Your job is not to capture every movement. Your job is to wait for situations where the potential reward makes sense relative to the amount you are risking, while accepting that the outcome remains uncertain. And this is another area where traders get themselves into trouble. They focus too much on being right. They want a high win rate. They want to predict direction correctly. They want to prove that their analysis is superior. But trading is not an intelligence competition. The market does not give extra money to the trader who makes the best prediction. It rewards good decision making over many attempts. You could lose several trades and still be perfectly fine if your losses are controlled. You could win several trades and still be in serious danger if your risk is uncontrolled. Imagine two traders. The first trader wins 7 out of 10 trades but risks enormous amounts when he feels confident. The second trader wins 4 out of 10 but controls his losses and allows his successful trades enough room to matter. Which trader has the healthier foundation? The answer is not determined by win rate alone. This is why I want you to stop thinking about trading as a series of individual battles. Think in groups of trades. A single trade means very little. One trade can be affected by news. One trade can fail unexpectedly. One trade can work beautifully. One trade tells you almost nothing about your long-term ability. But 100 trades taken under the same rules can begin to tell you something. That is where probability becomes useful. You are not trying to predict what will happen on trade number 1. You are building a process that can survive trade number 1 through trade number 100. That is a completely different mindset. The emotional trader asks, will this trade win? The disciplined trader asks, is this trade worth taking under my rules? That distinction is enormous because You can never know the result before the trade happens, but you can know whether the risk is acceptable. You can know whether the setup matches your plan. You can know whether your stop makes sense. You can know how much you are risking. You can know when you will stop trading for the day. Those are the things you control, and the things you control should receive most of your attention. There is another trap that catches experienced traders too: overconfidence. You have a good week, maybe 5 winning trades. You feel like you finally understand the market. You start believing you have figured something out. Then you see a setup. Normally, you risk 1%, but this time you think this one is different. So you risk 3%, then 4. The market does what markets do. It surprises you, and suddenly several days of progress disappear in one trade. This is why a good trading system needs rules that protect you from your best moods as well as your worst moods. Your risk management should not only protect you when you are afraid, it should protect you when you feel invincible, because confidence can be just as dangerous as fear when it becomes certainty. And there is one final thing I would add: never confuse a bigger position with a better opportunity. A trader may see a setup he likes and think, I am very confident about this one. But confidence is not a measurable edge. The market does not know how confident you are. You can feel 90% certain and still be wrong. So instead of increasing risk because you feel certain, keep your risk stable and let the results accumulate over time. If your strategy genuinely has an edge, you do not need to force it. You need to repeat it. That is one of the hardest lessons in trading. You don't become successful by making one extraordinary trade. You become more capable by making ordinary decisions correctly, over and over again. And that can feel painfully slow, especially when you see someone online turning a small account into a huge number in a short period of time. You start wondering, am I too cautious? Should I be risking more? Why is everyone else moving faster? Be careful. You are comparing your process to someone else's highlight reel. You don't know their losses. You don't know their account size. You don't know how much leverage they used. You don't know what happened before the screenshot. And you certainly don't know what happens after it. Your job is not to move faster than another trader. Your job is to remain in the game long enough to become better. That is the part people underestimate. Survival creates experience. Experience creates pattern recognition. Pattern recognition creates better decisions. Better decisions create consistency, and consistency gives you the opportunity to grow. But you cannot reach that point if you keep destroying your account every time you feel frustrated. So when I think about risk management, I don't just think about percentages. I think about protecting the future version of myself. If I lose today, can I still trade tomorrow? If I lose tomorrow, can I still trade next week? If I have a bad month, can I still follow my process? Can I remain calm? Can I continue learning? Can I look at the chart without needing it to save me? Those are the questions that matter. Because the goal is not to avoid losing. The goal is to make sure losing does not control you. There will be days when you make a great trade and lose. There will be days when you make a poor trade and somehow win. Do not let the second one teach you the wrong lesson. A bad decision that makes money is still a bad decision. And a good decision that loses money can still be a good decision. Judge yourself by the quality of the decision. Then let probability handle the outcome. This is where trading starts becoming less emotional. You stop needing the market to validate you. You stop needing every analysis to be correct. You stop feeling personally attacked when price hits your stop. You stop chasing. You stop moving your stop because you cannot accept being wrong. You stop increasing your position because you are desperate to recover. You stop entering because you are bored. You stop trading because somebody else is making money. And slowly, something changes. You become quieter. You watch more. You wait more. You trade less. But the trades you take mean more because they actually belong to your process. You begin to understand that doing nothing is a decision. Walking away is a decision. Taking a small loss is a decision. Closing the platform is a decision. Protecting your capital is a decision. And sometimes the most profitable thing you can do is protect yourself from your own emotions, because the market does not have to destroy your account. You can do that yourself, not intentionally, not because you are careless, but because you allow one emotional decision to become another. One loss becomes revenge. Revenge becomes overtrading. Overtrading becomes larger risk. Larger risk becomes fear. Fear becomes a moved stop. A moved stop becomes a large loss. And the cycle begins again. Break the cycle at the beginning. Make the first loss small. Make the second decision calm. Know when to stop. Know what you are risking. Know where your idea becomes invalid. And most importantly, accept the possibility of losing before you enter. Because if you cannot accept the loss, you should question whether you can afford to take the trade. This does not mean you should become emotionless. You are human. You will feel fear. You will feel excitement. You will feel frustration. You will feel disappointment. The goal is not to eliminate those emotions. The goal is to stop allowing them to make financial decisions for you. You can feel afraid and still follow your plan. You can feel excited and still keep your position size normal. You can feel frustrated and still walk away. You can lose a trade and still respect yourself. That is discipline, not the absence of emotion. The ability to act correctly while emotion is present. And perhaps that is what most traders miss. They think risk management is about protecting money. It is, but it is also about protecting decision making, because your capital is not just the money in your account. Your capital is also your ability to make another decision tomorrow. Every time you protect your account, you protect another opportunity to learn. Every time you avoid revenge trading, you protect your future. Every time you refuse to chase a move, you protect your discipline. Every time you accept a small loss instead of turning it into a disaster, you become a little harder to break. And eventually, you realize something. You were never going to control the market. You were never supposed to. You were supposed to control your response to it. The market can take a trade away from you. It can hit your stop. It can reverse after you exit. It can move without you. It can do everything you did not expect, but it cannot force you to revenge trade. It cannot force you to increase your position size. It cannot force you to move your stop. It cannot force you to enter because you are afraid of missing out. Those decisions still belong to you. And that is where your power is. Not in predicting every candle, not in finding the perfect strategy, not in knowing exactly where price will go. Your power is in deciding how much you are willing to lose before you participate. Your power is in walking away when the conditions are wrong. Your power is in accepting that some trades will fail. Your power is in refusing to turn one mistake into five. Your power is in staying alive long enough to learn. So the next time you see a setup, don't immediately ask, how much can I make? Pause, look at the chart, look at the situation, and ask yourself, if I am wrong here, am I completely comfortable accepting the loss? Not because you want to lose, but because you understand that losing is one of the possible outcomes. Then ask, if this trade loses, will I still be able to take the next good opportunity without changing my behavior? If the answer is yes, you are thinking about risk correctly. If the answer is no, the position may be too large. And if you cannot accept the loss at all, maybe the trade's not worth taking. That realization can save you more money than another 100 hours searching for a new strategy. Because sometimes the trader you are trying to become does not need more information. He needs fewer emotional decisions. He needs fewer trades, smaller losses, more patience, more acceptance, more consistency, and more respect for uncertainty. You do not need to win every trade. You do not need to predict every move. You do not need to recover your losses today. You do not need to prove yourself to the market. You only need to make the next decision correctly. Then the next one, then the next. And if you can do that long enough, something begins to change. The market stops feeling like an enemy. Losses stop feeling like personal failures. Winning stops making you reckless. Losing stops making you desperate. And trading becomes what it was supposed to be all along, a process of making decisions under uncertainty while protecting yourself from the consequences of being wrong. That is my risk management strategy. Not trying to avoid every loss, not trying to predict every move, not trying to become rich from one perfect trade, just making sure that no single trade No single day and no single emotion has enough power to take me out of the game, because the trader who survives long enough to learn will always have another opportunity. And sometimes the greatest edge you can have in trading is not knowing when you will win. It is knowing that when you are wrong, you will still be there tomorrow.